No conference would be complete without talking about the aftermath of COVID and its profound impacts on our industry. We're going to talk today across asset class, but really how COVID affected all asset classes and frankly how in some ways it really brought asset classes together and we're observing more convergence. My name is Lauren Hochfelder. I am the co-CEO and head of the Americas for Morgan Stanley Real Estate Investing, which is our real estate private equity arm. We manage about $57 billion of real estate on a global basis, cross-asset class, obviously cross geography. But I am really excited to be joined today by three phenomenal panelists and friends. So if you don't mind introducing yourselves.
Hello, everyone, and thanks for having me today. Scott Brinker, the president and CEO of Healthpeak Properties, an S&P 500 company based in Denver. We specialize in medical office buildings and life science properties, so thank you.
Andrea Olshan, president and CEO of Seritage Growth Properties. We're actually not a REIT anymore, but we are still a publicly traded company. It's all the real estate that was Sears and Kmart that was spun out in 2015. I took over 2 years ago.
And I'm Michael Bilerman. I'm the chief financial officer and chief investment officer of Tanger Outlets, which is a factory outlet company with 36 centers across the U.S., soon to be 37 in Nashville, September 14th, if anyone wants to come. We also have two up in Canada, my home country. We're about a $2 billion equity market cap company, $1.5 billion of net debt. And in my prior life, I joined Tanger in early December of last year. I spent 20 years as a research analyst, 18 of which was at Citi. And before that, I was
a top-rated research analyst.
But I've been here before for those, but it was in a different capacity. Now I actually have to answer the questions rather than ask the questions. I think I like the old. I'll see at the end of this if that old role was easier.
Great. So perhaps just to frame it quickly, obviously we've seen significant shifts in occupier preferences across sector, across market, and in turn, investor preferences and asset class pricing has shifted quite a bit. I think Exhibit A that we all sort of think about, or at least I do, is industrial. Obviously, COVID really propelled industrial net absorption, industrial rent growth, and in turn asset pricing. We were all sitting at home and e-commerce penetration spiked, but we're also seeing a reorientation of the supply chain. So COVID did many fabulous things to industrial. I think perhaps the surprise was many expected when industrial goes up, retail goes down, and I think to Michael's great content, indeed, we did not see that happen as much as we expected. In fact, retail sales continued to do well. So I want to go through each of the asset classes, but perhaps we can start there.
Great. So I think from a retail perspective, what was interesting about COVID is, as difficult as it was for everybody, it actually reinforced bricks and mortar retail. And initially, from a credit perspective, everything was closed, so it actually washed out a lot of the weaker credits that were hanging on in the industry. And then as things reopened, the bricks and mortar retail was so critical for each of the constituencies, whether you were a retailer, a consumer, or within the local communities. And COVID actually came out and said, you know what, from a bricks and mortar presence, you need it. And you need it to fulfill to the end consumer. That last mile, which Amazon still hasn't figured out, I don't know if how many people read, they're now going to charge $1 for certain returns, right? And so that ability, and I don't know how many people order on Amazon? I assume a few, yeah, all right. Okay. So you order on Amazon, you order a bunch of different things, and you get 4 different packages at different times of the day, right? So they haven't figured out that last mile. And so from a bricks and mortar presence, that last mile distribution was extraordinarily important of their supply chain. But it also was very important for the retailer to build their brand awareness and be able to connect with their consumers in different ways. And I think prior to COVID, there was such a distinction between you either e-commerce or bricks and mortar, and then it was all, you have to be omni-channel. And if you think about it today, it has to be a unified channel, because the consumer, they want what they want when they want it. And that local store is critical in the way they think about how they approach what they're trying to get out of from a goods perspective, the social interaction that it provides. Like all the things that we got locked down in reinforced why that in-store shopping experience is so important. And if you think about those two legs in terms of the retailers and the consumers, what a lot of the retailers found is that store drives so much more volume for them in that local market, that if they close the store, they start to lose that sales in that local market. And so that ability was a very big thing that came out of COVID. And then from the community standpoint, you think about how the centers were used. And that also became, that physical presence was such an important part of the overall chain overall.
And so when you talk about communities and you talk about retail centers as communities, what really comes to mind is the degree to which all real estate asset owners are focused on curating really interesting mixed-use environments. Yeah. You no longer have, or in large part, you no longer have single uses, right? We're realizing that medical office coexists with retail. People want to live, work, play, and that is really coming together, I think, in a way that was predicted for decades, but is really upon us. Scott, looking across Healthpeak's portfolio, you obviously have these mega campuses. Just give us some insights.
Yeah, I mean, we prefer to have real estate that has critical mass. If you think about the two businesses that we're in, medical office being one, the two primary participants in healthcare are the patient and the physician. You think about the physician, most of their business comes through referrals from other physicians. So it makes a lot of sense for them to be on one site where they have this critical mass of activity and referrals. It's good for business. And if you think about it from the patient's perspective, they're looking for convenience and value, but it's much more convenient to have all of your healthcare in one location as opposed to various locations around town. So we've really built our medical office business. We try to be close to one of the leading hospitals in the market. Even though the hospital is kind of losing market share in terms of the whole total healthcare pie, it's still where healthcare begins, and it's a critical part of the industry. But hospitals themselves are no longer just a box where inpatient healthcare happens. You really need to think about a hospital as a campus where a range of healthcare is being provided, and a lot of it now is on an outpatient basis. It's more than half of a hospital's revenue now comes from outpatient healthcare, and a lot of that outpatient care is delivered in a medical office building. And we prefer to have a critical mass of activity, usually 2, 3, if not 4 buildings on the same campus. It allows us to recruit higher quality talent, whether it's for leasing or property management. And if you think about it from an asset management standpoint, it's a lot easier to do asset management on a small number of properties with critical mass than it is to have things completely spread out. So in a lot of ways, in a lot of sectors, you minimize risk through diversification. Our view is in medical office, you minimize risk through concentration, as long as you're with one of the leading health systems. And then in the lab business, perhaps this is true more than any other sector, having local scale is critical. You think about some businesses benefit from national scale, so economies, systems, there are clearly some savings at a national level, but for life science, it's all about local scale because there's so much velocity from the tenant base. They sign a 10-year lease, but within 3 to 5 years, they probably need either more space or less space. In the more real estate you have in a local market, you can accommodate that velocity. So one group needs less space, another tenant on the same campus needs more space. So we own plus or minus $10 to $12 billion of lab R&D real estate. It's 100% in 3 local markets, Boston, San Diego, San Francisco. And most of the campuses are between 500,000 and 1 million square feet. And we usually have another one almost right next door so that we have that critical mass to, because the scientists in the companies work the same way. They're collaborating. They're sometimes taking talent from one another. Rarely are they just doing drug discovery on their own. They're collaborating with other companies or scientists that have different expertise. So having that critical mass is really a differentiating factor. And if you think about, when real estate cycles are booming, all landlords are happy, but that doesn't always happen. And we're starting to see that right now. There will be cycles. And in the down cycles, we feel like the highly amenitized big campuses in both medical office and lab will outperform. It doesn't mean they're immune to what's happening, but on a relative basis, they'll be better protected.
So as we talk about the relative attractiveness of different sectors coming out of COVID and how that might have shifted, Andrea, you're perhaps in the most interesting position because unlike Michael or Scott, you have an open canvas. And
unencumbered by tenants is what we like to say.
Well, we can market through anything. No, but in all seriousness, since you've taken over as CEO, you've done such a phenomenal job of stepping back and really thinking about what's the highest and best use for each piece of clay, for each box, for each piece of dirt, et cetera. Maybe help us understand how you've gone about that process. And I imagine at certain points, what you thought might be the highest and best use when you walked in the door has changed over time.
Sure, absolutely. So a few things. One is, I think when I walked in, there was 189 properties, and we went asset by asset, and what we realized is it really was 189 different business plans, which is not easy to execute, obviously, but due to the fact that they were either Kmart's or Sears. Sears tended to be part of a mall, often encumbered by an REA. Kmart's tended to be standalone. They tended to be in more tertiary markets. Scott and I were just talking about a site we sold in southern San Francisco as part of a mall. Alexandria bought it for a very healthy sum of money. They bought the mall, we were the holdout, and they bought us, and they're turning into a massive life science campus. That was the highest and best use of that site, for sure. Likewise, we have a site in La Jolla, adjacent to University Town Center. I don't know how many of you know that area in San Diego. Similar, it is great for life sciences, but it's also, to your point about, in the environment today, we're seeing a lot of residential interest as well. So, and tech office. So we took, there was the original Sears box, and then there's about, call it 15 acres of parking lots that are being entitled by the city. So a lot of what I've done is work with municipalities to entitle vacant land, either if the box is vacant, we look at it as the whole site, or if the box has some sort of tenancy that I've inherited, we look at finishing the leasing of that and then entitling the parking lot, because they tend to be, the average site is over 13 acres, which is a pretty impressive amount of land. And so in San Diego, we took what was slated to be an Equinox and an Industrious co-working space and made it 2 floors of Amazon office. Obviously a huge compression in cap rate, but also bringing 250 people to the site, most days of the week. And so...
most is an improvement over many markets.
Most, according to them. And then the parking lot is being entitled for, millions, plural, square feet of either life sciences, residential, because again, there's critical mass, and really the mall serves as the amenity. And so we're able to build so much more density of revenue generating space because you have all the F&B and all the shopping as the amenity that's already right there. Medical office is something that we've incorporated a lot into our properties. We have a mall with, we owned our piece, Howard Hughes owned the mall, and we did a joint venture with them, and Folger Pratt, who's a local DC developer, came in to do the development, and we sold a large site to Inova Health. And so our anchor is actually a large hospital. In Aventura, we have a premier site at the Aventura Mall, a former Sears box, which we redeveloped into 250,000 square feet of office, medical office, and retail with a lot of F&B, because there's not a lot of really exciting F&B in that submarket. And people love the fact that we have easy parking and direct access to parking, and we actually have underground parking. I will not discuss the logic of building underground parking in Miami, close to water. But we have a delightful bathtub that's sitting, so your car is safe and sound. But regardless, we have there's a lot of discretion that you can go, and so we actually leased a very large section to CCRM, which is a reproductive health group. So a lot of people are not very public about needing fertility help, and so the fact that we have direct parking with an elevator up to a third floor, very large office space is something that you don't think about, but was a very big issue for the doctors and for the patients. And so we've been very successful in working with people like Scott and groups like that and doctors groups to have some alternative uses.
And so, Andrea, you touched briefly on REAs and entitlements. We think a lot about occupier preferences, investor preferences, but the reality is that the municipalities have their own preferences, and your abutters may have their own preferences as to how they'd like you to use your own land. What have been some of the challenges you've faced as you've tried to navigate?
Sure. What things should be and what things can be are two different things. And it's really unfortunate, and I think we see this the most in California, which ironically has been so vocal about needing housing, and they have this statewide mandate of how much housing they need to produce and affordable housing, and yet they are some of the most difficult areas in which to entitle housing. So that's been really a challenge. And what we see is that it takes up to 24 months, and the cost of those entitlements actually makes the development unprofitable, and that's why you don't see the developments. Likewise, REAs were, I don't know, many of you know, sort of reciprocal easement agreements in shopping centers, where basically it was an agreement that was conceived when the malls were built, that the developers at the time couldn't conceive of any higher use than a department store for the space, and they really saw the department store as an amenity, and they wanted to protect that you didn't turn that department store into something else because it would hurt the mall. Now, often these malls, well, I completely agree with you. I think people were nostalgic for retail in COVID. They also had a lot of money in their bank account thanks to the government. Retail has really been booming. Our sales leasing velocity across the industry is way up, and sales are very strong. But malls are too big, by and large.
We don't own any malls, just FYI. Nothing.
No.
We're open air shopping centers.
So they're too big, and there's a lot of, we're a country that loves to build, and we over-retailed, and I think COVID also flushed out a lot of that. So not just the retailers, but retail, which has been very helpful. But there's no question that you don't need a fifth department store, and you probably don't need a third empty department store that you're trying to fill. Correct. And I think that what's unfortunate is that often the REAs restrict you. And so we try to do things that are different, but because of all the owners, there's a ton of hold-up value. And that has been really an issue for us. And they're really the only way to overcome that. And these REAs also go on. We have REAs that expire in 2078. So there really needs to be sort of an over-the-top solution, or you're just going to end up paying off everyone if you even can. So it's unfortunate.
So you're speaking about bringing other uses into, let's say, unsuccessful retail. Mike, although you have successful retail, and you're still looking at bringing in other uses. I think you're now rebranding yourselves as an experience company, as I understand it. But bringing in F&B, bringing in other uses, maybe how, I understand it's sort of a virtuous ecosystem, but when you think about capital allocation decisions, return on investment, how do you look at that?
Yeah. And I think, Andrea brings up a great point about that mall model that had those REAs, the department stores, which created a little bit of conflict, right? Because you effectively had co-owners on a site. Mm-hmm. And so I think being able to control more of the real estate that your asset sits on provides you that optionality to deliver ultimately to the consumer what they want. Yeah. And the consumer, when they're showing up anywhere, they don't know who owns what building on what site. They can drive into one of our outlet centers, and there could be a power center on the other side that's owned by someone else, but they don't know. They see a big Tanger sign. They think Tanger controls everything. And so I think just that consumer lens, always going back to what the consumer and how they're using the asset base is important. And so for us, we're taking our cue from what the consumers are doing, what our customers are doing. And so our vision statement, which I wrote down just so I make sure I say it correctly, using customer insights and experience to inform the future of shopping. And so effectively what we're doing is that the customers told us they want more things than just going through each store. They want F&B. They want experience. They want to have other things on the site, and so that's what we're adding. And because we have the raw materials to be able to do that, the return on invested capital is very high. So some examples. We've added Dave & Buster's to some of our centers. We have X Golf. Has anyone gone to do the X Golf? It's like a virtual reality. You can go play any course in the world at the center. We've added a specialty grocer in one of our centers. We added other uses, whether they're furniture retailers, or we added Ulta Beauty in Rehoboth Beach. If anyone goes to Rehoboth Beach, there's now an Ulta Beauty that's there for you to shop in. So just trying to bring as much as possible to the consumer because that physical real estate provides it. Now, other uses, whether it's hotels, multifamily, we don't have that expertise, but we have the land to be able to joint venture or ground lease or sell the land off to that use to maximize the value of what we control. And all of it ultimately is to drive NOI for the ultimate center. But the deal itself has to stand on its own, right? And ultimately we feel as we've amenitized a lot of our shopping centers, it extends the dwell time, right? So if someone's coming to our outlet centers and it's a family, someone can go to the Dave & Buster's, some can go shop at the Coach, and someone can go to the Gap outlet, and creating that overall experience for the customer.
Yeah. So Scott, turning back to you, beyond these considerations that Michael and Andrea have been referencing in terms of on-the-ground real estate optimization, how, if at all, does being a part of a public company, does running a public company with shareholders who have presumably said, I want exposure to medical office, I want exposure to life science, and you are the best at it, how does that affect thinking about capital allocation beyond your express lanes?
Yeah, I'll make one quick comment on the previous question as well, because a lot of our growth is through development. So today we probably have 7 to 8 million square feet that's in active entitlements, primarily in life science. And when we think about mixed use, there's the aspirational side of it, and then there's the practical reality of what is going to work for that particular city. So, and you can see both extremes. In South San Francisco, you think about the Hollywood sign in Los Angeles. Well, the South San Francisco is the industrial city. They don't want housing. So the east of 101 submarket where most of the lab and industrial is located, right near the airport, as you head towards downtown, there is no multifamily, and they don't want multifamily. So we're entitling plus or minus 3 million square feet today. It's entirely lab. What they do need is infrastructure. So we're helping them, fire stations, et cetera. It's very site specific. What we're doing in Boston is the complete opposite extreme. Boston wants housing. Mm-hmm. So to get density for lab, and we control 40 acres in Cambridge, to get the lab density that we want, we're going to have to deliver a lot of residential because Boston has a pretty extreme housing shortage. So each situation is a little bit unique in terms of what mixed use makes the most sense. I think it's site specific and in some ways city specific, where it's another reason that it's beneficial to do things in scale because the city of Cambridge or South San Francisco doesn't care about the owner who has a 1 acre site. Yeah. If you own 40 acres or 30 acres, now you can be a meaningful part of delivering something that the city wants. Yeah. And that's pretty darn important as a developer.
Yeah, and frankly, you're aligned more substantially with the goals.
Yeah. I'm sorry, what was the question you asked me? Sorry.
The question was just being part of a public company format, running a public company, if that affects the decision making.
Well, we're not allowed to work together because, we can't go create this mega diversified REIT, even though Lauren runs a diversified portfolio. Why doesn't the public market allow for this?
Michael
They
should
do.
answer
Your
this
stock
question.
price
Yeah, just goes the other way.
$7, yes.
The
I mean,
public
Michael,
market
putting
is
your
not-
old hat back on, what advice do you have to the REIT community for this?
I mean, I think it's hard. Like, I do think the companies are more diversified today than the market gives them credit for, right? And I think you look across all the different REIT sectors, and if you listen to the office panel, well, there was a couple of office people this morning, and Christina was talking all about all the different office companies, and they diversified more so probably because the office business wasn't great. That's just my impression, right? As they all went into other things that were more exciting. I think mixed use works when you do it from a position of strength, right? How do you take a great site and make it better rather than going into multi-property type? Because it's hard to be a expert and a specialist across all different asset classes. However, you can, I think, be very efficient if you own a site and create the highest and best use. And I think what Scott's doing in Cambridge fits that mold that the investors probably are okay with.
Yeah.
Yes, so on your question, I mean, we're a publicly traded company, but it's a real estate company at the end of the day. And my view on what creates a successful real estate company over time is A, be in a sector with good fundamental demand, and then B, have scale and expertise. And those are the things that drive whether the company's going to be successful or not. And scale is helpful, particularly for a public company in today's world. So our own view is, although we're in two distinct segments, A, there is a lot more overlap than maybe at first appears. But if we can check the box of, is there good fundamental demand? Yes. Do we have expertise? Yes. Do we have scale in each? Yes. It doesn't make logical sense to me that those two should necessarily be split up. I think there's a lot of arguments that putting them together makes them even more powerful as a combination. Nadeem said it earlier, 90% of commercial real estate is owned in the private market. Virtually every private real estate owner does multiple things. So why it would be that in the public market, an investor or owner would only do one thing, I'm not sure that makes a whole lot of sense to me.
Yeah.
If they're good at it and they have the scale to do it well.
So on the topic of sort of doing one thing, Michael referenced the difficulties around office, and we won't go down the rabbit hole. But
I collected a lot of money last night every time that people were saying negative things about office. I just grabbed all of it.
Yeah. One solution, I mean, this is long before COVID, before we, realized people don't apparently like going to work anymore. Conversions. And every underperforming office building became a life science conversion.
Right.
Obviously, when you have phenomenal rents and not a lot of incremental CapEx, it turns out the math works well.
Yeah.
How do you see those faring? I think it's like a third of the supply wave that's coming. Do we have to be purpose-built? Will these conversions succeed? And is there more behind it now that the rest of the office is underperforming?
Yeah, I mean, so there's no, black and white, yes, no answer. I mean, conversions can work in life science, but more often than not, they don't. Most office buildings are not in the right location or submarket. They probably don't have the right zoning. And the physical plant is almost across the board not capable of doing lab. So it requires substantial investment in terms of floor loads. A lot of times the ceiling heights just don't work, period, no matter how much money you spend. Loading docks, I mean, there's a long list of reasons that most office buildings don't convert well to life science. Frankly, the property type that converts the best is industrial, but those are in pretty strong demand now too, so you don't see too many of those, but they're essentially one story with high ceiling heights, and that's what is needed for a lab building. So we've seen some be successful. Some buildings are more capable than others. Some sponsors are more capable than others. But our view is through the cycles, the purpose-built, amenitized campuses are going to far outperform the conversions, and we've seen exactly that to date, and I think that relative outperformance will get even more extreme as we go through what's admittedly a down cycle relative to where the lab market had been.
And so, look, I don't want to delve again further into a conversation on office per se and the degree of disruption there, because I think it gets enough airtime. But the work from home trend has also affected other asset classes. So, beyond how we've had to turn our office buildings into hotels to get people to show up, our residential has changed, right? We look at programming our residential with not just sort of larger units to accommodate home office, but amenities that include hot desks, et cetera. People sort of migrated more to the suburbs now that they're not coming into city centers as frequently. That presumably helped suburban retail. But, Andrea, looking at you, as you've thought through, again, molding the sort of optimal use, have any of these trends impacted how you've programmed things? You're taking things so far through pre-development. Have you pivoted?
No, it's a great question. I think, what we're seeing is the daytime populations are so high, right? So people want to be attached to a shopping center in a way that when they went to the office 5 days a week and they left at 7:30, 8 a.m. and they came back at 6, maybe they did takeout from one of the restaurants in the mall. When they're working from home, they're around all day. And you should probably put working from home in air quotes because they seem to be really around and around and about. And they want to be near places where there is shopping and there are places to go. And so we're seeing, open space used to be a requirement of cities. It's now a requirement of tenants. So just, the pet owning population, that's like a huge part of it. And they're around with their pets during the day at home. Yeah. We're seeing a lot of townhomes. People like that because they're working from home. They want a different floor. They want to be able to work on a different floor. And they will tolerate walk-ups in a way that New Yorkers call them walk-ups. They call them, townhomes or stack flats, but they're walk-ups. And people will do that so that they have different spaces when they're home and they feel like they have space. But to us, the biggest thing we're seeing are secondary markets booming. I think Florida, so many of our assets in Florida that are encumbered by REAs, attached to malls, not in the easiest municipalities, going for multifamily over and over and over again. And, people want to, they want to live in different environments. They want to live in low tax states. They want to be able to live in an environment that is, like you said, live, work, play, and they want better weather because they're around more and they're out of the office more. So we're seeing a lot of that across the Southeast and just in general in secondary markets.
And that's exactly where, that feeding off of that that's exactly what we've seen in our portfolio over the last number of years coming out of COVID. And the Tanger portfolio is predominantly Eastern Seaboard, Southern, and so it's in the face of all of this growth where we found people were coming to our centers at different times of the day than they did before, and that has continued, which really then drove the retailers to want to, come and occupy more space. Our leasing volume was up 50% last year. As we've been able to fill in. We talked a little bit about adding all those uses of F&B. It's driven by exactly that work from home trend where people are just working from also other places. And so a lot of our centers are in tourist driven drive-to destinations or in key suburban markets. And it's almost like we're recreating city centers in these suburban markets, and that's where all of these uses and the whole convergence coming out of COVID, because now we've separated out that 5-day work week going back and forth, where they want that convenience of buying online, picking up on store. And when they go buy online and pick up on store,
They buy more stuff.
They buy more stuff.
Yeah.
Go figure, because they get attracted to something. It's so much easier for a retailer to sell something in the physical world and create that brand loyalty. And predominantly in our portfolio, it's all branded goods because that's what we sell. And you think about all the department stores, like those brands have suffered in a large department store. So they want to come out of that universe and come to an open air shopping center because they're not finding the same level of traffic.
But it's interesting, you make a great point about working in different places. We're seeing this with grocers. Grocers have grown because they're adding cafes. And when you go to grocers all over the country, and I don't just mean Whole Foods, which I mean a lot of brand new Whole Foods, and especially in Texas and other some certain better emerging markets, have like 5 restaurants. I mean, it's like unbelievable. There's like a bar, there's a coffee shop, there's a restaurant, and people are working at Whole Foods literally all day long and eating breakfast, lunch, dinner, and probably 800 snacks there all day. They're also, we're seeing it where it's distribution centers and grocers.
Yep.
So on the high end, it's restaurants, and on the middle to lower end, it's distribution centers. So you take these boxes, historically, we moved 200 square foot boxes, and what do you do with them? And we had to chop them up, and construction costs are astronomical, and you're splitting systems and everything else. And now we're finding these grocer distribution centers are taking these boxes, to your point about the convergence of sort of industrial and realizing you could fulfill the last mile there. So it's interesting, the trends that we're seeing as people just don't work, live in secondary cities.
And I don't think the genie's out of the bottle. We're not putting the genie back in. Like the convenience and the technology about being able to work really from anywhere. I mean, it puts more stress on a manager to manage the workforce and ensure that you're creating all those in-person experiences. But this is the new way to work. And I also think from just a demographic perspective, my wife works full time, and the ability to have that flexibility of being, still being a mom and also having that flexibility of going into the office when she wants, I think is also extraordinarily important, for society as we evolve.
It's been fascinating to see, just from an office utilization standpoint, how different it is across geography. Okay, a little bit of difference in the U.S., Texas, Florida versus others. But really, if you look globally, the U.S. still stands around 50% office utilization, New York, San Francisco, around 40%. But you look across the sort of Asia, the countries in Asia, they're at 80% plus. And so when you sort of reference it in the context of just how humans use space, it's fairly fascinating to see just these cultural differences. And, we think a lot about, the differences among the regions. Europe today still, office seems to be holding up quite a bit. But when you talk about the genie out of the bottle, we do debate, is there infection, so to speak? Do these trends, both the behavioral ones and the capital markets pricing trends, do they start to jump across the pond or to the other side of the world? So coming at the question of asset class convergence from a different perspective, we're also seeing a convergence in investor demand between what you might call sort of the traditional core real estate. Some would call it sort of the core food group. Some would call it sort of the old world economy. I think it depends on what you own. But we've seen a convergence between that, so the office, resi, industrial, and so-called niche sectors. Or demographic-driven sectors, secular-driven sectors. And, I see in our own portfolio, and we've been fortunate to partner with Scott and his team on some of this, we've really pivoted over the last 10 years to more healthcare focused, to more student housing, self-storage, et cetera. But these were sectors that, frankly, when we went into it as a global sort of diversified asset manager, it was considered a little niche, and we got some questions like, what are you doing? And today I feel like those have become the new core. Right. But you were there long before it was cool. I mean, you really chose healthcare early. What are you seeing? Why do you think there's been such a step change fairly quickly?
Right. 20 years, so there's some luck involved. When I think about real estate, it's there to serve the economy, and the economy evolves. So it's different today than it was 20 years ago, and the same will be true 20 years from now. So core real estate today is just different because of that simple fact. Healthcare has strong secular demand. It's 20% of our GDP and growing. Mm-hmm. It's a pretty important asset for most people, their health. So they're spending more on it and are willing to pay for good healthcare. It didn't hurt that the yields were higher for a number of years because it was a niche, that it wasn't as popular. So that always attracts investor attention, especially if it also performs over time. A good initial yield and performance over time is a nice combination. And then the specialized expertise I think investors are willing to pay for, whether it's in the private market or public investors, At least today, it is still a bit of a niche asset class where specialized expertise, relationships, people are willing to pay for that. That maybe in traditional office or other asset classes, maybe they don't feel the need to pay that premium because it's a relatively easily understood asset class and multiple people doing it. So I think all of those played a factor. I don't think that will last forever, but I think that helps explain the tremendous growth in the last 20 years. When I started in healthcare, we were considered a healthcare company, not a real estate company, although we were technically a REIT, but I think the asset class probably summed up to $5 billion of asset value. And the company I joined had $1 billion, and we were one of the biggest. Today, it's a $150+ billion asset class, so it clearly has captured investor attention, and it's less cyclical than other real estate sectors. I think that helps as well, but that doesn't mean we're completely immune from cycles, especially as more people come into it. The cycles get more dramatic on the way up and on the way down.
Medical office and life science. Has more.
Yeah, that's true. Medical office is more of a steady business. Life science has more opportunity to go above and below the long-term trends. So, we're seeing that today.
But the market's accepted diversified healthcare, right?
Sort of.
Sort of, but at least you have 3 large companies that are involved in different facets. And while you guys reduced your senior housing exposure between life sciences, MOBs, skilled and senior housing and hospitals, those all have different trends. It's all healthcare, the same way that residential, the market still is not, we have single family, we had student housing, we had multifamily. The REIT market should allow for these broader, at least in my view, broader sort of trends. If you are, you shouldn't be beholden to one vertical, as long as you're not going, on the other, on the interstate versus the highway, it has to be related.
Have you spoken to a lot of REIT investors?
Yeah, a long time.
Yeah, so exactly. It's hard to understand.
Right.
I mean, I've spent 2 years, it was a joke in the office because I was so passionate about our, all of our, Ks
uniqueness.
And Qs.
Right.
No, all of our Ks and Qs, I was like, they have to tell the story. You have to tell the story. You have to simplify the story. You have to simplify the story. You have to tell the story. It's still, people don't get it. And we've been telling the story, and we've been breaking it down, and we've been showing, because it's harder to understand.
Right.
We were a less profitable company trading at $40 a share because we had a very simple story. Sears paid $2, you put in $100, you get a tenant to pay $20. That was not value maximizing.
Right.
In most places, at all. That was actually destructive of value. We traded at $40 a share. Once we actually told the story of, hey, it's 189 properties with 189 business plans, and some of them I should sell to Alexandria to do a massive campus, and others I should entitle and sell to Toll Brothers and sell to Avalon and do a JV with Howard Hughes and sell it to Innova and do medical office and entitle land, and here, look at all the ways we're entitling value. They're like, whoa, that's complicated. I don't know what cap rate to put on that. So and that really has been the biggest issue, and it's valued. It pushes you to be less value creative and creative, period. And it's really because of the investor base. And it's been so interesting to me as a first-time public company CEO to speak to investors, because it's so obvious as an investor, having come from the private side,
world, right.
where every day I got up in the morning thinking, how do I maximize value? How do I create generational wealth? How do I maximize value? How do I increase cash flow? How do I lower my credit risk? All these things. Literally, I got up every morning thinking about all of them all the time. I bring that to a public company, and people don't appreciate that. They want a simple story with one, put a cap rate on it, and
consistent
do the
earnings,
math,
consistent
and
growth,
that's
without
it.
right.
There's no question. I think that's more pronounced in the public space. I mean, unequivocally. But I would say we see it in private land too. And at the end of the day, one needs to look through to what role am I doing? My clients at the end of the day are our investors. My sole purpose is to meet their needs. And there are investors who are in real estate because of the yield. And those investors probably do want that simple story. And, that's probably they're viewing real estate as somewhat of a fixed income alternative. Query whether that comparison is going to look quite as good going forward. But it is, whereas you have others who are saying, you're in my portfolio for the alpha. You know, you're sort of my private alternatives, and I'm going to look at you versus private equity. And real estate is so diverse in terms of the investor base as well as the role our asset classes play for these underlying investors. So I'm sensitive to the fact that we are basically out of time. But
that big light's flashing at us.
Yeah, but if Robin will allow, I'll just ask if there's anything any of you would like to add.
No, okay.
Okay, thank you.
Thank you, everyone.
Thanks, Lauren.